Hi everyone, a very good evening and a very warm welcome to all of you at this Edelweiss Konnect Classroom session on 3 ways to rebalance your portfolio. This is the first ever session under this initiative and we plan to have a series of these interventions which are aimed at simplifying concepts and enhancing its understanding and applicability. My name is Vikram Masand, and I joined Edelweiss AMC family in the month of May of 2021. At Edelweiss Asset Management, I head learning and development. Prior to Edelweiss, I was with HSBC Asset Management in a similar role, and where I spent about 6 years. And before that, I was at Reliance Asset Management, which is now known as Nippon Asset Management, for about 7 odd years. Before that, I've had retail experience for another 5+ years. But that's enough about me. I think we should steer this discussion more towards what is our agenda and our topic. And what I would also like to request all of you is that during the course of this conversation that we're having, during the course of this presentation that I'm going to share with you, at any point in time, if there is any query or question which comes to your mind, then please put it in the chat window. I will answer it towards the end of the session. In fact, I'll be more than happy to respond to all your queries and questions towards the end. So on that note, let me share with you what our agenda is. We will start with talking about the various classes of investment. Moving on from there, we will move to something which is known as asset allocation. And in asset allocation, we will also be focusing upon ascertaining, or how do you ascertain the risk-taking capability whilst you are deciding on your investment. When we talk of asset allocation per se, what I would like to even harp upon over here and share with you is, for a lot of us, we have some kind of an asset allocation done. It could either be by design, or it could be a default asset allocation strategy. When I say by design, what I actually mean is you would have probably gone to a financial expert. He or she would have ascertained why are you investing, which in financial parlance goes more with the word goals of investment. And post goals, probably, he or she would have also shared some kind of a questionnaire to ascertain the type of risk that goes on, or which you are comfortable to take with. And post marrying both of these, would have probably come up with some strategy which is known as an asset allocation strategy. So this is by design, or it could be by default. When I say default, what I mean is, for a lot of us, we have money, and whenever we have money, we invest that money. We may go and buy some stocks. It could be direct stocks, or we could invest in mutual funds or start an SIP. We could go and book an FD. We could go and do an RD. We could go and invest in gold. We could go and probably buy some real estate. So as and when, whatever money I have, I may decide to invest some part of it. And thus what happens in this is, it's a mixture of various asset classes in which I have made my investment, and this becomes a default asset allocation. So I didn't plan for it, but because I have invested in various instruments, this becomes a default asset allocation that has taken place into my portfolio. In both these situations, whether it is by design or it is by default, the good part is that there is some kind of an asset allocation to begin with. Okay, so once we speak about asset allocation, then we will talk about, should you rebalance your portfolio? And if yes, then when and how? And more importantly, what we will also try and talk about is what would happen if I do not rebalance my portfolio? These are, so rebalancing is something which we would want to focus more upon, because like I said, it could either be by design or by default. You may have a certain asset allocation, but post asset allocation, if you do not read, should you rebalance, or if you don't rebalance, what could probably happen is something wherein we will be focusing upon towards the latter half of our presentation. Moving on to investment options, just like everything else, when it comes to investment options also, there have been a plethora of options now available. You could invest in equity, you could invest in mutual funds or equity through mutual funds. You could do an FD, you could invest in gold. In gold also there are options in terms of you could either buy gold bonds, you could buy gold bars, you could make some jewelry. Although jewelry, is it an investment or no, is a question which a lot of people openly debate, and I don't want to get into that. You could even do gold ETFs. Silver ETFs is a new category which is just about getting started, and people are talking about it. Then there is real estate, where people are investing. Then there's also the exotic investments like art and watches and various other things. All of this is adding to the number of options which are available, and frankly speaking, somewhere even adding to my confusion. So that's when it comes to investment options. What is more important is to decide whether this investment option is suited for me, and if yes, then how much of my investment should be in this option. And this is done by devising something which we call as an asset allocation strategy. This strategy predominantly aims to balance my risk-taking ability along with my need for investments. The asset allocation strategy is predominantly devised by taking into consideration, let's say, if I am the investor, then first my goals, it could be the more traditional goals like retirement, buying a house, children education, professional education, the ones. Or it could be a little more exotic, like buying a super bike, like going on an adventure, or a unique holiday, unique different type of a holiday. Or it could be redecorating my house. This is something which a lot of people have done in the pandemic, and now are realizing that they should probably, because they spend a lot more time at home, you should probably be doing a little more of redecoration in your house. So it could be any of these goals. And once you have the goal, what becomes even more important is to decide by when do you want to achieve that goal. So the investment horizon period. Now, again, over here, it could be a short term, medium term, or a long term. In a short term, it could be going for a holiday or going for a super bike, could be a short term goal. When you talk of a medium term goal, it could be, redecorating your house again or buying a holiday home. When you talk of long term goals, it could be retirement or education or any one of these. And this is the goal and the investment horizon. You decide upon your risk-taking ability. That is, how much risk are you ready to take with your investments in order to achieve this goal. This will decide on the percentage of investment that you deploy into each of the asset class which suits your investment or risk-taking appetite. Right. And this, you could create a combination of investing into equity, investing into fixed income, investing in gold, buying real estate, or any other thing. In order for you to be successfully reaching for your goals, this is one of the most important decisions that you would be making. Okay. Moving on to, like I said, understanding the risk bit, right? And risk, if you honestly ask me, is nothing but a deviation from an expected outcome. So then the question that comes to my mind is, what is that expected outcome? So whenever I'm making an investment, in my mind, there is a certain expectation of returns from that investment, right? It could be anything, right? Whatever I have studied, or I have looked at past records, or I am looking at my own expectation and basis that setting my expectations around it. you know A- any deviation from this expectation is the risk that my investment is getting exposed to, right? Ideally, for a lot of us, or rather, let me say, for most of us, we would love to be in a low risk, high returns. High returns again is a matter of personal opinion, but whatever. Low risk, high return kind of an investment uh, avenue. Personally, if you honestly ask me, I haven't personally come across any investment which fits into a low risk, high return kind of a place. So for me, if you honestly ask me, this is nothing but wishful thinking. But in order to be comfortable with my portfolio and its returns, it is extremely important for me to understand my own risk-taking abilities, capabilities. So that's where the risk becomes a centrifugal core for me to ascertain where should I invest, how much should I invest, because basis my own ability to absorb that volatility or uncertainty, whatever you want to call it, is how comfortable will I be with my strategy of investments to reach whatever value I want to create over whatever period I have invested my money into. Moving on next to portfolio balancing. Let's talk about portfolio rebalancing, rather, not balancing, rebalancing. Okay, if you honestly ask me, this is nothing but regular maintenance of your portfolio. It's like going to your doctor for an annual checkup. It's like going and getting your car serviced periodically. It is nothing but the process of realigning the weights of the various investment instruments in your portfolio. Let me give you an example. Okay, so let's take an example. Let's say you have created a portfolio in which 50% of your investments are in equity and equity related instruments, and 50% of your investments are in fixed income instruments. Okay, just for this purpose of simplification, I'm taking two asset classes. Okay, so this is where you start with 50% in equity or equity related instruments, 50% in fixed income related instruments. Let's say the year following your asset allocation has been a good year in terms of the equity investments, and your equity investments goes up by 20%. Okay, so in your overall portfolio, the weight of equity or equity related instruments would then become 60%, and simultaneously the weight of fixed income and fixed income related instruments would fall and go to 40%. You don't do anything, let's say one more year, again you had a good year in terms of equity or equity related instruments, and this becomes 65 or 70%, and subsequently your fixed income portion becomes 30 or 35%. Okay, so post, let's say two and a half, 3 odd years, you are sitting in with your portfolio wherein the balance has shifted from 50-50 to, let's say, a 65-35, 70-30, more skewed towards the equity side or the volatile side of investments. The first thing that comes to my mind over here, if I see this, is Am I comfortable with this new balance? And if I am, very honestly, then why did I not start with this? Because had I started with the 65, 35, 70, 30 instead of a 50-50, I would have probably, made more money. So in that sense, that's one example. Let's say the reverse of this happens. Okay. And you start with 50-50, but let's say the next 2 or 3 years is not a great year for equity and equity related instruments. And this shifts, this slides down. And now in your overall portfolio, let's say the fixed income side becomes heavier, and that's at about 65, and equity is about 35 or 70 and 30, whatever proportion you want to talk it. Again, the question that comes to my mind is, am I comfortable with this? Because, we all know probably fixed income over a long term may not give me the high returns or the returns that I had anticipated from my equity side. And then in that sense, if I have something like a goal or a value that I want to reach towards the end of the investment, with this shift in asset allocation, will I still be able to get there? And if I will, then why have I started with an investment where I'm exposing my investments to a higher degree of volatility, to a higher degree of risk, when I could very well achieve the same value by a lower degree of volatility and a lower degree of risk? So that's the first question which comes when we don't do anything. And that is why what is also seen is, if I do not rebalance over a period of time, your portfolio will get skewed, and in all probably get skewed more towards the volatile or the a little more riskier investment asset class that you have invested into. In order to avoid this, the only way to do this, to avoid this, is by rebalancing your portfolio. Rebalancing ensures that your investments are in line with your own risk-taking comfort, aligned to your investment. If I do not rebalance, I would be exposing my investments to a higher degree of risk. Okay, my investments may turn or would turn overweight towards the higher performing volatile asset classes, which in the long run may not augur well with my overall investment strategy. And hence it becomes, if you honestly ask me, rebalancing is a very, very important component of your portfolio asset allocation strategy. It is also very important for you to ensure that whatever thought you started with in terms of your investment, it could be because there is a certain comfort level, it could be because there is a certain need to, let's say, expose your investments to a certain degree of volatility or whatever it may be. In that space, I am sticking to that comfort level wherein I am comfortable, and not over a period of time exposing my investments to, let's say, any greater degree of volatility or risk. So that's why you rebalance. Moving on is, when should you most certainly rebalance? Okay, I have two situations, okay, and two situations wherein you must rebalance, even if you haven't even before that. Okay, so you could evaluate your own selves and the situation that you are in. And if you are in any one of these two situations, then the first thing that you should do is you should relook at your portfolio and check whether there is scope for rebalancing, there is a need for rebalancing. Because when you will do that, in any of these two situations, if you are, then you would probably think that yes, there is. The first situation is when you're closer to your goal or redemption. Okay, let me put this with an example. Let's say I invested for the purpose of my child's higher education. Let's start with this. And I thought that by 2024, I would need, let's say, a value of 50 lakh rupees. Just giving you a number to start with and to build this up as an example. Today we are in 2022, start of 2022, and I would need, let's say, somewhere in about May, June of 2024. So about 2.5 years from now. Let's say I have already reached about 42 lakhs. Okay, so it's been a good run. I've not done anything. I invested, let's say, about 10, 12, 15 years back. And this investment today in my portfolio shows a value about, let's say, 38, 40, 42 lakhs, anything around this value. I know that it's been a good run because of the value that it has created. In the next 2.5 years, this should reach, right? And obviously, when I look at it, I feel very happy because whether it was by default or by design, I invested some money. I thought that, this money may be of some use to me later on. And today, when I evaluate, I see that I may need this money for my child's future education, for example. It could be to buy a second home or whatever else it may be. And I see this value coming and I feel very happy with it. And I've not done anything, okay? So now this is where my situation is currently. Let's say the next 2 years are unfortunately not very rewarding when it comes to my volatile or the equity side of investments. Okay, let's say that's that's what happens. So now where earlier on I was at a probability that everything goes in the same pace, I will reach that 50 lakh rupees, which will give me that comfort zone, because one of the asset classes have not performed as well as it was. There is a very high probability that somewhere my value will not be close to what I anticipated, but it will be less than that. So I'll be a little short. Now, could I have avoided this? I could have probably curtailed this volatility to a certain extent by seeing that, I have reached a certain value, certain level, and now I could have rebalanced to control the downside to a great extent. Because I did not do that, somewhere I just exposed my investment to a higher degree of volatility, because obviously over this period of time, my skewness, towards the volatile asset class probably increased, which then got reflected also in my overall returns towards the end when I needed the money. So if you're closer to your goal, if you're closer to thinking that I want to redeem my value, you must look at rebalancing at the earliest, so that it helps you protect your investment from any higher degree of volatility which you may not require. So that's the first thing that you must do. And let's say the second thing is when your life situation changes. Okay, you could win a lottery, you could get some inheritance, you could fall, unfortunately, let's say seriously ill, or let's say when there is a new member joining in your family. Okay, all of these are life altering situations. And all of these situations have a certain bearing in terms of my own risk-taking abilities, in terms of my own outlook towards how I want to, look at investments, look at probably my own life in the future. And hence, it becomes extremely important that whenever this situation in my life, which changes, and it changes, my thought process, or my requirements, I should look at rebalancing my portfolio as and when a situation like this arises. So two situations wherein you must rebalance. One is when you are closer to your goal, or when you think that you would want to redeem your money in the next year, 2.5 odd years. So you should rebalance to curtail the volatility to as much extent as possible. And second is when your life situation changes. because this changes your own personal risk-taking abilities and the dynamics of your investments. And basis this, you must again relook at your portfolio and rebalance, looking at now your newer ability to absorb risk. So in these two situations, if you are, or if you're getting close to any one of these two, please, please, please relook at your portfolio and rebalance. Let's move now towards 3 simple ways to rebalance. Okay, there are 3 simple strategies which I'm going to present to you, and you could use any one of these. First is according to a time frame. Let's say once a year. Let's say we are in Jan, okay, and every year January you decide you will relook at your portfolio and rebalance. Let me give you an example. Let's look at some simple numbers to start with. Let's say you invested 1 lakh rupees and created a 50-50% allocation in equity and fixed income. Equity and equity related instruments and fixed income. So 50,000 goes in equity or equity related instruments and 50,000 goes in fixed income instruments. Okay, let's say post 1 year, this equity has performed very well, and let's say you've got a 20% return. So this becomes 60,000 rupees, and let's say the fixed income has given you a 10% return. So 55,000 plus 60,000 rupees at the end of year 1, you are at a value of 1,15,000 rupees. Okay, so if I divide 1,15,000 rupees by 2, I come to a value of 57,500, which will be the correct 50-50 split. So in a situation like this, what I do is in every Jan, I check what my total portfolio value is. I'm looking at a simple value of 50-50. It could be 60-40 or whatever is your comfort level. Okay, I'm doing 50-50 primarily to make the example simple. I divide it in the same proportion. In this case, it is a divide by 2. So in this situation, what I will do is I will sell 2,500 rupees worth of equity or equity related instruments and invest into the fixed income side to rebalance this and make it 57,500 each. Okay, so this is according to a set time frame. You could do it. So you do it every year, and you follow this diligently for your entire investment cycle. The second example is when your asset allocation target strays by a certain percentage. Let's say you talk of 20%, for example. Okay, so or 15%. Let's say 20% se start karte for our discussion. Let's say you invested again 1 lakh rupees 50-50. So 50,000 in equity or equity related instruments and 50,000 rupees in fixed income related instruments. And let's say at the end of 1 year, let's say in Jan, you check. You see that your equity related instruments have touched a value of, let's say, 57,000 odd rupees, and your fixed income related instruments has touched 54. So you say, okay, my own comfort is 20%. So none of these asset classes have touched 20%. So I'm going to stay put as it is. So let's say come April 2022, your equity or equity related instruments now touches 60,000 rupees, which is 20% of your 50,000 rupees. And your fixed income has now become 15,000 rupees. Sorry, 55,000 rupees. Okay, so now that there is a touch on 20%, or your asset allocation has strayed to a level of 20%. So in the month of April of 2022, what you will do is you will rebalance. How will you do that? Again, same methodology. You look at your portfolio. In my case, it was a 50-50 split. So I add 60 to 55. I again come to 1,15,000 rupees. I divide this by 2 because it was a 50-50 split. And basis this, I again sell equity or equity related instruments to the tune of 2,500 rupees and invest that excess money into the fixed income side. So again, I come to a 50-50 split. Okay, and the third one is, at a set time frame, but only if my target allocation has strayed a certain percentage. So for example, I think that I will only do it in January. Okay, so let's say January 2020, and my deviation, let's say, is again, let's say 20%. Okay, so January 2020, I saw equity and equity related instruments grow from 50,000 rupees and become 57,000 rupees. Fixed income has grown and become 54,000 rupees. I don't do anything. I stay with as things are because it has not strayed my number. Now I will stay put for the entire year. And let's say in Jan 2023, I relook at my portfolio, and my portfolio is now showing equity and equity related instruments to grow and become 62,000 rupees, which is a breach from my 20% comfort. And my fixed income side has grown and become, let's say, a 56,000 rupees. Okay, so when I add 62 and 56, I come to a number of 62, 72, 82, 92, 102, 112, 118. So 1,18,000 rupees is my total. So now, because there is a breach, it is when in the calendar time that I am looking at, in the time frame that I'm looking at, I will divide this 1,18,000 by 2, which comes to 56,000 rupees on each side. 1,18,000, sorry, 59,000 on each side. So from 62, what I will do is I will sell 3,000 worth of equity or equity related instruments and reinvest that money on the fixed income side. So this is how I will rebalance. You could choose any one of these three strategies. You could do it at a time frame. You could do it basis a target allocation, target asset allocation. Whenever it strays a certain percentage, then I will rebalance. Or you could use as a combination of both of these. I will do it only and in this time frame, and only if I am straying from a certain percentage. Either one of these three is an approach which each one of us can take. But the important part obviously is that you must take an approach to rebalance. If we do not rebalance, there is a high probability that I am exposing my investment to skewness towards an asset class which was not originally the plan, or which was not my intention. And in order to ensure that I am staying within my own risk-taking comfort, rebalancing is a very, very strong tool which we all must partake and focus upon, at least on a once a year basis, or at least when there is a breach which is beyond my comfort level. So on this note, I'll just like to take some questions. I have some questions which have been sent to me by all of you people, and I like to answer them one by one. So there's a question which says, how much amount of gold should be there in a portfolio? So globally, the average exposure to gold that people or financial advisors talk about is to not go beyond 5%. So that's the average that people are talking about. Predominantly, I think in India, at least there was a higher demand or higher exposure to gold. But was that really an investment, or was it for lack of options or my lack of knowledge is a separate discussion. I think about 5% of a portfolio can very easily be in gold. Okay, so there's a question on global equity, and we have now started considering global equity in portfolio. So for global only, US is a good idea. A few other markets like China, Taiwan, also good for investments. So any suggestions? Very honestly, it's very personal. What you think, whether you know the markets or how you want to know the markets. US obviously is a big market which everyone knows about. There are newer funds in terms of China and Taiwan too, but how comfortable are you? How much do you know about it? It's more personal, very honestly, and I would not want to diverge too much into what should be or which are the markets which you should be looking at. It's more of a personal choice whether you understand those markets, or whether there is some kind of a philosophy that you would want to follow in terms of investing in those markets is something which you should be looking at. Okay. What is the ideal asset allocation for higher risk and moderate risk? So ideal asset allocation in terms of higher risk could be anything between 75-80% tops to on the equity side, and between 20 to 25 on the fixed income side. And your moderate could be anything between 65 to 75% on the equity side, and the rest being on the fixed income. I'm for simplification just keeping it between equity and fixed income, but predominantly this is the broad overall number that you could probably look at. Would you take some examples to explain what is advised as a ratio of various asset classes? How to rebalance, how to evaluate risk versus reward ratio, what should be the trigger for mathematically for shift, should we stay only in equity if time horizon is 20 years? Okay, what is advised as a ratio of various asset classes is again a very, very personal thing. How much risk am I okay to take with from my investments should decide on how much exposure I can take on any asset class. So it could be, it could be that I am a millennial, and but in my head I'm very conservative and I am looking at preserving my wealth. So I would obviously, in being a millennial, wherein the general thought goes that this person can take a higher degree of risk, but if my mindset is conservative and I'm not comfortable with it, there is no point in pushing on that side. At the same time, it could be that I am getting close to retirement, but I enjoy my investments and I enjoy a certain degree of volatility and risk, because of which I like to take a higher degree of exposure on the volatile side. So it's very personal. You can't generalize this to for keeping for textbook purposes also. How to rebalance is something which we spoke about. I hope that you were here, and these are the three strategies that we spoke about, as per a time frame, as per a target stray, or as per a combination of a target stray on a certain time frame. So that's how you rebalance. What should be the trigger for shift? As I said, if it's a target based approach, whatever is your comfort beyond which you are not comfortable. So I took an example of 20%. It could be 10%, it could be 5%, it could be 15, it could be 25. Whatever is your comfort number. I personally do not think it should be over 20%. But whatever is your comfort number, you could do a calculation around it, and as and when your asset allocation weights are straying from that and breaching that comfort number of yours, you must rebalance if you're looking at it from a mathematical purpose. Should we stay only in equity if time horizon is 20 years? Again, it's very personal. Should you or should you not? Depends on how much of a risk are you ready to take, how much of volatility are you ready to absorb, and how confident are you with your own investments. It's something which cannot be a ballpark, that because it's 20 years and it's long period, and history has shown us that over a long period of time, equity has generated much higher returns in comparison to other asset classes. So yes, you should put all your money there. It's about my personal comfort too, and that is where my own risk-taking abilities and capacity becomes an important element to decipher before deciding on the investment asset classes that I deploy my money into. Okay. So there's a question about, please describe the second example of inheritance amount while rebalancing. Okay, so when we spoke about these two situations, and I said inheritance. So inheritance is obviously when you get some sum of money. Now this sum of money, when you redeploy, whatever idea or whatever goals that you had for your investment, this money will help you reach there faster, right? Because there's an extra investment which was not calculated for, and because of this, you could very easily rebalance and relook at your asset allocation strategy. That's the example, and that's how you could look at inheritance. Okay, cryptos have evolved enough seriously as an alternate asset class. Very honestly, I have no views on crypto. It's not something which I have learned or which I have studied in depth. So I would refrain from responding on any queries with regards to cryptocurrencies, please. If our client is already invested in MF and inherits some amount, then why and how to rebalance? Okay, so because let's say you have somebody who has already invested in MF, or you have a client, or you yourself have invested. Like I said, because there is an inheritance which has come, it is going to add to your investment, because of which whatever purpose or goal of investment that you were anticipating that you would want to reach, now because of that extra sum of investment, you would reach there, much faster at the same asset allocation, and hence it becomes important for you to reconsider the balance of your portfolio and rebalance it according to now the new situation that is coming. Okay, can rebalancing be algorithm based? Any some instrument available? So in terms of algorithm, you could set up systems which tells you when is your portfolio breaching a certain percentage, and basis that breach, you could you could look at creating a rebalance strategy. So is there any tool available in the market which tells you of a breach or notifies you of a breach? I'll have to do my study around it, and if I find something, I would love to share it with you. And if you do, then please share it with us. Is rebalancing like timing the markets and works against a long-term investor who does not have any financial requirement or future goals? So is rebalancing like timing the market? It's not. It's in fact, ensuring that you are in that space wherein you are comfortable with your investment asset allocation or investment allocation. So it could be a retired person, it could be somebody who is young. Everyone's got a comfort level of volatility which he or she can absorb. So rebalancing ensures that I am within that comfort and not straying beyond it. So that's where it is. So if I do not have any financial requirements or future goal, and I am investing, if I don't have a requirement, obviously, then I don't mind expose. And mentally, let's say if I'm in a space where I don't have any requirement, then primarily I am investing because just for the fun of it. So in that sense, yeah, I mean, whatever kicks you're getting with that money is something which could be a totally different, reason for investments. Also, rebalancing will lead to tax out for these set of investors. So for these investors, will keeping the portfolio as such long-term yield better return? So like I said, if you don't rebalance, closer to your goal, there is a probability that, because of the skewness and volatility, you may not be able to, get the value that you wanted. So if I just think of just one element, which is the taxation element, because of which, let's say, I do not create the value that I could have had I rebalanced, then is just thinking about taxation alone worth the effort? So I personally don't think so. And hence I think rebalancing is a very, very strong tool to ensure that you are able to stick and achieve your financial requirements as and when you have planned for, and you're absorbing the volatility and curtailing the volatility as much as you need to in order to achieve that amount. Okay. How do you handle taxation part during rebalancing? As I said, taxation is one part of the story. The important long-term story is to manage my personal risk, is to manage my investments, and to manage my reason for investments, which is the larger picture. If I'm making money, and there is a tax to be paid, how many of us would mind that or wouldn't mind that? It's a question. But primarily, what is important is I reach my requirement whenever I need it. And hence, and if you're talking about, adding an extra element of risk, which may either make me reach faster, I may be happy, but I may not know what to do with that money, so I can splurge it out, or because of, the extra volatility, I did not reach there. both situations I may not be very happy with, and hence rebalancing ensures that I am within that comfort cycle of the risk-taking need that I need to take. And hence I think it is a very, very strong element that we must focus upon. Okay, one more question. How to calculate your portfolio's volatility or risk reward ratios? Are there some auto calculators, softwares, or any manual method? So volatility is something which you can look at in terms of beta, in terms of trainer ratio, at least in terms of mutual funds. This data is available, and you could look at this data, which will give you an idea of the volatility and the reward to volatility that your investment is getting. So this data is available, and you could use that as a volatility meter if you wish to. But when you're talking about rebalancing, you would have to check upon how comfortable are you with the volatility of your investments. Okay, and basis that, decide upon what should be your mix and what should be your target asset allocation, beyond which if it strays, then you may want to rebalance. Okay, so I guess that's all the questions that we had, and appreciate all your questions. I hope I've been able to respond to all of them, and respond them in a way that has been able to to satisfy whatever your question was. And on that note, I would like to take end this session and thank you all for your time. It was a pleasure to be here and do this. And as I said earlier, we will be doing a series of programs in the coming future, wherein we will be talking about a lot of other topics too, which will help all of us in enhancing our own knowledge, our own understanding, and taking this more of an application route where I can then apply this in my day-to-day life and use it to make the best use of the newfound knowledge that we've had. So on that note, I'd like to once again thank all of you and close the session over here. Thank you, everyone. Thank you for your time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.